Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I have a company in this portfolio that has done absolutely amazing over the last 3 years. The company is called Broadcom. Broadcom is a technology company that makes chips and software for various industries. Their chips are used in many electronic devices like smartphones, routers, data centers. They also have a software that helps businesses manage their IT systems and security side of things. And it's been one of the best performing stocks that I've had over a lot since I actually started this entire portfolio. Now I've been getting questions because I am up quite a bit, and I'll share that with you guys at the end of the video. But I've been asked quite over the last 3-4 months, what am I going to do with this company? Am I going to sell it? Am I going to keep it in the portfolio? Am I going to trim it? Because it's up a lot, and people are saying, what if it goes to zero? What if something happens to the company? So I'm gonna share with you guys today everything I know about the company, InshaAllah, and then I'm gonna tell you exactly what I'm doing with it at the end. If you haven't joined us in the Patreon account, please do so, because you get access to a lot of things, including the Discord, all the buys and sales for this portfolio, the family portfolio. You get high quality stocks that I put together, which I'm updating currently. Get all the undervalued stocks. You get the Sharia compliant investing ebook that I put together a couple of years ago. You've got dividend trackers, which I'm currently updating, and you've got the watch list, which I've updated recently. So you've got a lot to get your hands on, inshallah. It will cost you $5 basically per month, and of course to trial it out, see, and really helps the channel to pay for all the subscriptions that we use, because a lot of the things that we use is actually paid for, so that will be very helpful. Right, the company we're talking about today is Broadcom. As you can see, for the 1 year, it's up about 68%. A year to date is up 61%. For the last 6 months, only up 20%. I say only up 20%. There are companies that are down over 20% in that time. And for the 1 month, it's just about 1.5%. So as you can see, it has done really amazingly since the beginning of basically 2024. And a lot of it is because of the AI situation, and everything basically is the company has been involved with, it kind of tagged along with Nvidia. I'm just going to give you an overview. This is basically the company's details, which you can find on their actual website. All of these things are available to you. So for the fiscal year 2024, the net revenue basically was over $51 billion, which is absolutely huge. They invested basically $3.9 billion of basically research and development, which is quite nice. They've got a lot of IP portfolios basically of that patented right now, which is absolutely amazing to see, because that protects this company from their competitors. This is one of the reasons why the company has a wide economic moat. This company is basically a bunch of companies that came together or basically been acquired by this company over a period of time. And the latest one, 2023, was VMware, which is absolutely huge buy. So they've got all these type of companies that basically came together over the last years, and they have two main businesses. They've got the software side of things, okay, the infrastructure software, and they got the semiconductor solutions, and these are what is included each one of those things. So the networking side of things, they have the enterprise service providers and hyperscale data centers. So they cater for all of these people, all these companies and so on, technologies if you like. They've got the server and storage connectivity on premises, and they've got the enterprise. They work with those enterprise. They also work with the hyperscale data centers. And then they also have the end-to-end solutions, which is mainly a lot of the networking side of things. Okay, all these Ethernet devices and Wi-Fi routers and so on. They have the mobile side of things, so wireless mobile device connectivity. You basically for taking care of all of these things, all these little devices that use any sort of a connectivity. Basically, majority of these company devices are made by this company. Then you've got the industrial, which is the automation side of things, renewable and automotive. So those are three sectors, and as you can see, the factory, you've got the renewables, and you've also got electric cars or EVs and so on. Then you've got electronics and so on, and then you've got enterprise class, the software side of things, and this is where VMware comes in. Okay, so a lot of this is what they already had. In fact, this is basically the cybersecurity side of things. They did have it already, but because now they've also included VMware into their portfolio of companies, VMware comes with all of these technologies already, including the hybrid cloud infrastructure, the app delivery acceleration, the basic security side of it, and the software defined edge, and so on. So all of these things put together this is what they generate. So the net revenue for 2024 we've already seen. Let me just zoom in if you can't see. $51.574 billion from 2023 when we were looking at about $35 billion. Now a lot of that comes from VMware, of course. Okay, it's not just organic growth. And gross margin here we're looking about basically in the 70s, which is absolutely amazing. Adjusted EBITDA. Basically, EBITDA is a financial metric that shows how many and how much money a company makes before taking into account non-operational expenses like interests and taxes, and non-cash expenses like depreciation and amortization. So if you the basically best way to look at this is the higher this number is, the better, basically. Okay, and as you can see, from $13.6 billion to right now $31.8 billion basically of EBITDA, which is basically is growing. And again, another thing that I always talk about is the free cash flow side of things. You can see $11.5 billion to right now $19.5 billion. So it is also heading the right direction. Now, the beauty of this company is a dividend growth company. And as you can see, they're growing that dividend every single year. Since 2016 right now, up until now, they grew that about 32%. And I think they've just increased that dividend, by 11% just recently, which is absolutely wonderful to see. So they are basically sharing some of the profit with us by giving us these dividends, and of course buying back their own shares and so on. And these are the management, basically the people that manage the company. Now, just to kind of show you the breakdown, as you can see here, this is the latest quarter. So the semiconductor solutions was up quarter over quarter about 13%, and the infrastructure software was up just a 0.4%, which is not a lot. And as you can see, the EBITDA was up about over basically almost 11%, which is quite nice in comparison to the last couple of quarters and so on. Now, I've already shown you basically the growth of that EBITDA, which is wonderful to see. But if you do it quarterly, that what we saw earlier is year by year, but if you see it quarterly, you can also see it's growing. So from financial perspective, the company is doing well. There are a few things we need to look at, and so let's do that first. So as I said to you already, the company has a wide economic moat. Right now they have a 843 billion market cap. So in a few months, if it continues the way it is, it will probably hit that $1 trillion. Okay, and the beta is actually quite low, which is quite interesting. Now, the current PE is 157, which is ridiculous. The forward PE is about 37, and the 5-year average is about 21. I promise you, when I started buying this company, I think it was about 18, 19, around that when I started buying first. And I remember, if you look at some of my old videos about 3-4 years ago, you will see me talk about this company and say this is undervalued company. And I talked about that at the time. I bought because of course I have a computer science degree. I understand a lot of the technologies. I've seen some of their products and we use it and so on. And I kind of knew the company's business side of things, and I knew it might be cyclical, and the fact that it was down at the time, I knew it's not going to stay there for a long time. Again, I could be wrong. Okay, I could be wrong. I could have been wrong completely and just like bought it wrong time, but at the time it was about 18. It didn't make any sense, so I bought it around that time. Now, as you can see, the 5-year average is about 21. This sector medium right now is about 25, so it's way higher even than the sector. It will be interesting to see what Nvidia's actually looks like. So in terms of dividend side of things, is 1.1 right now. The payout ratio 46%. That means they have room to increase if they need to. The annual payout is $2.12. The 5-year growth rate is about 15%, which is quite nice. The dividend streak is about 13 years, and dividend safety of A-. So free cash flow right now $18.6 billion. Free cash flow compound annual growth rate is about 15%, and free cash flow margin about 23%, which is absolutely huge. Profit margin, return on operating margins, return on equity, and return on invested capital, probably one of the best out there. Return on invested capital is not so great right now, but net income margin for this compound annual growth rate is about 24%. Total return the last 10 years, if you own this company, you would have made per annum about 34%, which is absolutely amazing. The revenue grew about last 5 years about 14%, EPS about 34%, and current ratio is basically below and above 1, which is basically what we're looking for. Okay, this company, I do think it carries a little bit of debt, so let me just quickly check, because I just want to check a couple of things long term. So current assets is basically, let's call it about $20 billion. Okay, total current asset, looking at total current liabilities, total assets is about $167 billion, 168. Current liability is about $20 billion, closer to basically this is why that number is very close. So basically the current liabilities and current assets are more or less identical. And when you look at the long-term debt, the company has 66, let's call it $67 billion, basically the total debt, long-term debt, which is not great. I don't like companies that carry a lot of debt, because that can easily change the game for us completely. But we will see where it goes. Okay, so but right now the current liabilities actually covers all of that. The revenue expected to grow about 17%. And EPS is expected to grow about 28% for the next year. Current price is $180 per share. According to Morningstar, it's $155 per share, 18% premium, and I do agree with them. Fair value when it comes to, overvalued when it comes to simply Wall Street, basically $163 per share. Again, 12% overvalued if you think about it. When it comes to Wall Street, this is where they change the game. These guys are using discounted cash flow models, which is basically what I use as well. But these guys are doing all sorts of things. God knows what they're doing. But these people are saying it's $200 per share. That's about 12% upside, 11% upside from where we are. It's a strong buy from them. $193. But these guys, about 8% upside from where we are. They're also saying it's a strong buy, which is fine. Okay, that's fine if that's their interpretation. You don't need to go away and buy the stock right now and run into it. Also to madness. But yeah, so in my opinion, I think this is more realistic than this here, because Wall Street is basically anything to do with AI right now. They just basically saying it's a buy. Again, they're taking a bit of risk, but it could pay off. Okay, that's the stock could still go another 20, 30, 40% next year. You never know. Okay, or it could go down. Business activity side of things, a 99% interest-bearing debt and interest-bearing securities is absolutely fine. Looking at the ordinary shares, as you can see, $4 billion. They have kind of diluted. I think is a lot to do with because they were buying the VMware. Repayment of debt, as you can see, from 20 billion they paid by 11 billion, 2 billion, 400. That was ridiculous. And then they paid again basically $12 billion here. Repurchase of capital, shares, basically stocks, basically that they're buying back. They're also buying back their own shares, which is quite nice. And free cash flow, as you can see, from $11.5 billion to right now $18.6 billion is heading the right direction, and it is growing. Right, two more things and then I'm going to stop. Final thing, well, two more things. This is the in terms of stock valuation side of things. As you can see, the company's Broadcom. We've seen all this data. Okay, the dividend discount model that I used and discount cash flow model I used has given me about $150 per share, $152 per share. If you average the whole thing out, what you will end up is $162 per share. Right now it's $180. So for that reason, is actually overvalued. You might want to say, do you know what? This is a very volatile stock, and I'm going to give myself a margin of safety of minimum 10%. The margin of safety is good because because remember, what we're doing here is basically predicting the future, and no one can do that. So what you need to do is have some sort of a contingency in place if that doesn't happen. So that's your margin of safety. So if what I'm saying here is, if I'm wrong, okay, 5, 6, 7%, at least then I will still make some money or break even, whatever. So the margin of safety is a really good safety thing in place, right? $146 per share. If it hits between basically around 140 something, then it will become more attractive. That's just about $40 per share. And based on what I've seen in this company, to be honest with you, it can go up 5% in one day and 6% down next day. So that can easily happen. So 10% from where we are right now is not that big deal, and 20% is even basically doable. So right now, in my opinion, it seems very much overvalued, so I wouldn't touch the stock right now. So what I'm going to do now is just compare this company with a couple of other companies in the similar sort of a sector. Even let's compare with this. Texas Instrument, and what we want is the overall performance, or total performance if you like, or total return, and we're going to look at the 5 years first. And as you can see, Broadcom has done 540% in comparison to 90% of the S&P 500. You can have a look at the rest of them here. And then for the last 10 years, 2,200 total return from this company. S&P 500 less than 200%. So absolutely ridiculous. The others have done decent, but it's not, of course, as mad as this company has done. So that's what I wanted to share with you guys. Please don't go away and buy the company straight away. I'm going to show you what I own right now. As you can see, I have over £8,000 in this company. £6,000 of that, 6,200 of that is actually profit. $338 per, basically 38% up, which is absolutely ridiculous. My average is basically £6 or 48 basically dollars right now, and as you can see, this stock is basically over 200%, which is crazy. Why is it up 13% today? That is very interesting. Is that because they've... Do you know what? I actually forgot that they were reporting last night. So they've actually reported, and that's why the stock is up 13% today. Wow, that's crazy. So there you have it. I actually genuinely didn't actually look the fact that they reported basically just yesterday. So yeah, that's very interesting. So the yesterday night they reported, basically the information that I was just giving you early came from yesterday, because I thought they actually reported a couple of days ago. I didn't think it was just basically last night. And as you can see right now, about 13% up. So it's great. I own 50 shares. This is amazing. Okay. However, I think is really overvalued right now. Just wait for a drop. It might happen in the next couple of months. It might not happen. It'll be interesting to listen to the earnings call, which I always do, by the way, guys. I advise you to do it. You learn a lot about the company. So if you haven't basically listened to any of the companies that you own's earnings call basically where the CFOs and basically the CEO of the company and whatever all basically chip in and talk about how amazing the companies are, and then all the analysts basically will ask some questions, really good questions at times. Sometimes you can tell them you're this biased, but sometimes they ask very good questions. So it will be really good for you guys to go out there and listen to the earnings call, inshallah. Anyway, I'm going to stop the video here. Have a wonderful day. Assalamu Alaikum.